So I'm going to mute everyone. And all right, so I think everyone is inside. And with that, good morning, everyone. Great to see you. Welcome to our, I guess this is the first time we're doing a regional tax webinar for Moores Roland Asia Pacific. So anyone who's watching, so Moores Roland-AsiaPac.com. So the title today is Qualified Trust, Hong Kong versus Singapore versus New Zealand. And to deliver that talk, we have three very distinguished gentlemen. We have Joe Tang and Sebastian Hayos, both based in Singapore as well, and David Willis, who's coming to us from New Zealand. So just a bit of background on AmiCore from their website. So global team of over 700 specialists. AmiCore Group is a growing independent global provider of CorpSec and fiduciary services, providing entity administration services, including companies, trusts, and fund administration services, assurance services, and outsourcing services. Now, without further ado, I hand it over to you guys. Joe, you're in charge.
Just unmute. Morning, everybody. Well, thanks for the extensive introduction, Darren. That means I can actually leave it immediately to my colleagues, David Willis, who's based in Auckland, New Zealand, and Sebastian Hayos, who's based in Singapore. I'm also based in Singapore. Just practical matter, if you have any questions while we are talking, just raise your hand or unmute yourself and ask the question. It's we encourage people asking questions while we're going through the presentations. So David, can I ask you to share your screen and start off for today? David?
Yep. So I was trying to unmute the screen. So the screen's pretty little, so I'm trying to press all the buttons and I'm trying not to lose myself. Yeah, hi everyone. I'm in Auckland, down in New Zealand here. What we thought we'd do is just go through. First of all, I'll tackle some of the New Zealand things, just a very basic thing on trusts, and go through some structures and some things that you'll see in New Zealand of the law and some of the tax aspects. And then Sebastian will follow with some of the other aspects with Singapore, and then we can have a Q&A. Now I need to share my screen. I've got a few, rather than stare at my face, I've got a few slides which might be a bit more, I don't know if they're interesting in my face, to be honest, but at least you'll be able to see some words on a screen. I'll just try and share. I don't know if I've got access to share my screen. Does Darren, I do? Oh, sweet, okay. Let me see if I can find stop video. Yeah. Right. It's not letting me share anything. Let me look down the bottom, share screen, PowerPoint. Right, hopefully, yeah, perfect. Okay, so I'll just make that a bit nicer to view, hopefully, without losing everybody. Okay. All right, so basically what we've got here is it's just a little introduction. For those who aren't familiar with trusts, this is fairly sort of basic sort of concepts in terms of what a trust is and splitting the legal and beneficial ownership of assets. But it's basically, it's some people forget when we're talking about tax, people get pretty excited and start calling these things entities, which I guess for tax purposes they are, but for the pure sense of the term, they're not entities at all. They're just basically obligations. So your settlor, the person creating the trust with the assets, gives them to somebody else called the trustee, who has a whole lot of obligations towards beneficiaries, of which they can be one of. Generally in writing, it can also be for charitable purposes as well. You can mix and match purposes and beneficiaries from corporate individuals to charitable purposes all in one. Generally, we say they're in writing. In the old days, you can create trusts, but typically nowadays you see them. They're generally there's a deed, usually a deed of trust, or it can be a declaration. So that's very basic, but it is just remembering it is an obligation. So it's not a legal entity, as I kind of mentioned there. It's basically a set of principles and common law and the statutes where you happen to be setting your trust up. You are splitting legal and beneficial ownership, obviously, so from the assets. Usually it's the settlor will give them by way of gift, but there's other strategies that employed depending on the nature of the tax requirements of how they want to put assets in. It could be sale, buybacks, can be loans, things like that. Just got to be a little bit careful with those. And then we sort of have the trustee, say it's me, or the company becomes the legal owner. And all our name, the company name, trustee name is where you'll see your name on all the asset holdings. If it's property, it'll be Amicorp as trustee of the trust. If it's investments or bank accounts, it's the same thing. In the US, the US banks just like the name of the trust. Obviously, you know the trustee, but their trust bank accounts will be the name of the trust, which is different to some other parts of the world. Other parties that you might come across if you're dealing with trusts, if you're dealing with them a lot, is the settlor grantor concept. They sort of use interchangeable depending on where you're from. Protectors, beneficiaries, investment advisors, all these people can be corporates or individuals. Protectors, you can have committees in these things as well. We try and be careful not to give too much control to the settlor or the grantor, because there's a whole lot of case law that's been around for quite a long time now where if you have too much control, you can really jeopardize your trust full stop, which makes it a bit of a waste of time. Trust deeds themselves are very flexible. Most laws now, they have a lot of different aspects built into them. Whether or not it's discretionary, it's irrevocable, it's revocable. And those can be adjusted depending on the local law. I'm actually going to focus a little bit on New Zealand very shortly, but most countries will have their specific things they have in their law to deal with certain aspects of how they've created it, whether or not it's an offshore or onshore structure. And generally, another feature is that you'll see with these, as opposed to say something like a foundation or a company, is they've got a limited life in some cases. Most of them have a lifespan or a trust period or a perpetuity period. Not all. There's some jurisdictions around the world have no trust period. New Zealand, for example, is 125 years. But that's just to give you an idea. And the idea around that was that in the tax rules is the tax man wants to get taxed at some point. So the idea is that it distributes out of the structure at some point in the future. As I said, some other jurisdictions have no life, so it can go on forever, or dynastic, it can go on for a very long period of time. So there's some of the features that you have. Some of the locations that we do, again, I really want to focus on New Zealand, but just to give you a flavor of queries that you might have if you're dealing with things and you come across something and you think, oh, I wonder who I can ask a question of about this particular area, then, we operate in these areas at Amicorp, and we can certainly help. I can deal with a lot of queries myself. If it becomes very specific to a local law, we can delve into the local offices there to get the answers that you might require for clients, or you're just thinking about structuring something, or however it works, whatever works for you. The little funny asterisks is there just because of the nature of some of our businesses. So Switzerland obviously doesn't have its own trust law yet. So it sort of piggybacks on, say, the UK, Bahamas a lot. It can actually use any law it requires. So we've often worked with our Swiss guys in the New Zealand Trust. So it just depends on how that works. And our Bahamas office, it's not a licensed trust office. It's those sorts of activities at Bahamas are done, say, through Cayman or through Switzerland. But if you do have trust queries, we always have to help. Right. And New Zealand, interesting stuff. So what's good about New Zealand? What's it all about? So it's quite a favorable jurisdiction worldwide, reputationally. We've never really been blacklisted by anybody. We're traditionally a high tax jurisdiction, with the exception of foreign trusts, which I'll mention at the moment. lots of access to double tax agreements, DTIA. We have a whole lot of different. We have signed most of the international agreements, multilateral cooperation agreements. We are a sort of a big player in that area. Our laws are pretty modern, robust. We've got our trust law was just modernized, just came into law just a couple of months ago. Before that, it had been around quite a long time. The Act was 1956, was modernized. It's taken them 20 odd years, or maybe not quite 20 years, but it feels like that long to get it updated to where they are now, which is a bit more sort of user-friendly for beneficiaries and for lay people to understand what trusts are about. The company law is pretty much in line with the rest of the world. A lot of our laws are kind of sort of, I guess their roots start from the UK, but not always. But our trust law certainly was. And it's very much in line with international standards and any legal cases that happen around the world, they take notice of. Government's pretty stable. New Zealand's been a lot in the last sort of 12 months because of its COVID response, which I don't know if that's good or bad, but at the moment our borders are still currently closed. We do have a nice little bubble with Australia, so you can come and go, but otherwise, if you're coming back into our country right now, you're going to be quarantined for a couple of weeks, which is probably similar to most places. Hopefully, we'll open that up a little bit this year, but makes traveling almost next to impossible unless you want to spend 2 weeks coming back in a hotel that you have to pay for. So our trusts, private trust companies are often the vehicle that we see the most of in our office down here, generally aimed at high net worth people. Family offices are generally interested in them. Just go through a little bit more of the detail why that is. New Zealand runs a settlor-based regime for taxation. So it's consequently that's a little bit like Hong Kong and Singapore and the expected it's more almost has a territorial type of feel. So if you're not a New Zealand settlor and you have any New Zealand beneficiaries, you don't have New Zealand assets, you don't have any exposure to New Zealand income taxes on the trust. So even though we are an OECD country, we have this regime in place, and it was pretty much set up to stop people like me setting up my own trust offshore and hiding it from the tax people in New Zealand. So they did it the other way around, and that's created a market here for some time now, which is good because with the world changing, some countries becoming less stable than others, they've always wanted a good place to put their assets and for their trustees and be trustable, that could be a word, and also to make sure that they know where everything is. So time zone wise, isn't that bad for us. European time zones are a little bit tricky, but generally speaking, I deal with most people at my night, sometimes really early morning, depending on how they're placed. So we do have a system, how you maintain this tax system, how does it work? Well, until recently, till very recently, there was a few changes a few years ago where we have to register trusts. So New Zealand operates that system as a reaction to the Panama Papers, all the negative things that have happened over the years. Then it's not a public register. So you do have to register them to maintain your tax exemption. But it's not something you can Google or dial into and have a look at. You just can't do it. So the regulator, the tax authorities are the ones who are maintaining this information. So just to make sure it's quite clear, it's not public at all. We don't have a lot of other tax in New Zealand. So if you're thinking about inheritance taxes, gift taxes, stamp duties, all those other things, we don't have them in New Zealand. It's pretty straightforward to income tax. Our other tax that we are subject to is GST or VAT, which is a fairly efficient tax from a New Zealand perspective. So when you're looking at distributions to beneficiaries who aren't residents of New Zealand, then they're not going to be subject to tax in New Zealand on that income, assuming that they haven't invested or put a big investment in land or buildings or something that's going to generate income for them, say an investment portfolio. Some people do actually want to do that. We have some clients who decide that they want to have a tax base, so they want to have an investment tracker fund or something in New Zealand. They want to pay a bit of tax for what helps them in the local jurisdiction. It's all subject to their advice, obviously. So we don't have capital gains here either. They've just if you're following news in New Zealand, they have been toying around with our real estate. This is fairly local, but the real estate market is almost, it's not out of control, but it's super hot. And the average person it's way out of line in terms of salaries and wages to house prices. So they're trying to put a cap on that a little bit, whether it's to do with investment properties, and they're holding investment properties for a certain period of time. So they used to flip properties, and it was always made me laugh when you'd have a front page newspaper saying, "I flipped my property, I bought it for a week and I've made $500,000. You think the tax people would be interested in that? Absolutely. And they've made some law changes to stamp that down a little bit, and they've increased. It's quite a technical area now, but they've increased the period from sort of a 5-year test to a 10-year test, try and curb some of the international investment into real estate property, pushing prices up, meaning local people can't afford to do it. But as we see around the world, house prices, property prices are still relatively high and a pretty good source of holding and good source of income in the future. So still, it hasn't really done anything right now to curb prices. So we are going to see how that goes in the next future, in the near future. So distribution of assets, tax-free in terms of if they're foreign assets, and that can happen up to the lifespan of the trust, which I mentioned earlier as 125 years. It was 80 years a few months ago. It's just increased. So just moving along to sort of for those, what a trust scenario, what it actually might look like. Now this is a scenario. It can fit into most places where it's a corporate trustee, it's a professional trustee set up. So there's lots of different committees and things going on there. But to give you a flavor, we use these quite commonly for consolidation of assets. So if you look down in the underlying entities, I've put underlying entities under the trust, but you can have trusts holding assets directly. We typically see that for low risk sort of things, bank accounts, things like that, things where they are not going to generate too much risk, obviously, from the trustee perspective. And we review these things from time to time to make sure that that's the case. If they've got lots of different assets, it's good to park them. They might already have a holding vehicle in mind. We can put that into a trust, contribute that into the trust. Some people get a little bit nervous about trustees because they don't know them. You know, where we're regulated, gives them a bit of peace of mind. If they have other issues, they can put people like protectors in to give control over the trustee a little bit, so the trustee can't distribute things out without consent. They can also have a little bit of input as well, depending on the tax situation or legal situation. They might not be able to have any say whatsoever in the running of the trust, which is quite good from a trustee perspective, makes it very robust. But if they want to have that, they say they might have some decisions on investments. You can sort of build those committees or even words into your trustee to allow that without any issues from a trust perspective. There's nothing really you can't hold, assuming it's if you can legally hold it, and obviously Amicorp's happy to hold it depending on what type of asset it is. If you can put it in a trust, or it can be contributed or bought or sold, depending on how you want to structure it, and that includes operating companies. So we have a number of clients overseas who are thinking about future planning, longevity, succession planning. All those things apply here. Operating companies, if they want a certain level of control, we can talk about that in the next couple of slides about how they might feel about trustees where they are professional trustees. Most professional trustees won't particularly like dealing with operating companies because they don't know anything about them. So there's a few things that we can do there to help and still have your trust structure set up. So if you think back to what purposes of your trust, you've mentioned estate planning, which everyone talks a lot about, protecting their wealth. It can be also used for retirement planning. You can also use these things for employee benefit type of structures, where you get more of the corporate sort of feeling. Unit trusts come into play here. Not so much in New Zealand. We don't use them in the foreign world because unit trusts are taxed like companies from a New Zealand perspective, but they are used a lot for other purposes overseas, especially for fund structures. And Singapore have those. And it also can be purely charitable. I work with a lot of charitable organizations where there's trusts involved. and we help them out from all over the world, whether or not and they can be very small or very large. It just depends on how they wish to have them and what they want to do with them. And some of the other trusts that you might see or hear a lot of are purpose trusts. We don't have purpose trusts in New Zealand, or we don't have non-charitable purpose trusts, where you see them a lot in the offshore world for just holding shares in, say, a private trustee company, which I'm going to mention next. Or you can have the more sophisticated locations like Cayman, which have Star, and BVR have Vista, which can be a mix of, they're very different regimes, but they're used, they can be used for purpose trusts as well. So I just want to go through that. And the next scenario I wanted to talk about was these types of arrangements and partnerships in New Zealand. They use a little bit where people want to have a New Zealand vehicle, because of our tax jurisdiction, we don't have a lot of, we have the foreign trust regime, but we have partnerships which are transparent. So with the partnerships, we can hold assets at the partnership level. Say if we don't want to hold the assets directly, as I mentioned earlier, where the general partner would have to be a New Zealand company. And that's just how the partnership laws work in New Zealand. And I've got 0% as a general partner because quite a lot of that's just how the law is. We're able to have partners that don't have a percentage. So we've got the limited partner having 100%, which is the trust in this particular case, and the general partner has 0. The good thing about that from a New Zealand company perspective is it's not taxable. So it doesn't have any income. It has no rights to anything. It acts as almost like a director. And you can hold assets through the structure quite nicely. And it's quite good for bank account opening, for example. New Zealand's quite well known internationally with international banks, so it's quite easy to open up bank accounts. We can also hold other operating businesses through this. It can hold shares in other companies. It can hold real estate. There's no particular restrictions on holdings there. So it just gives you an idea of what else you can do other than just having the trust in a New Zealand perspective. Now, with partnerships, you just got to remember, because they're a corporate vehicle, there is tax responsibilities. So there's tax filing, and there's financial statements requirements. The tax filing is mainly, it's more informational. The government wants to know what income it's generated, but you're not going to be paying tax on it unless you've got assets here. So it sort of operates similar to how the foreign trust works. So the other metric I want to talk about quickly was the private trust company. We talked a little bit about control, and how clients, how they feel about not having any control, which is a problem for some people. So we have been doing a lot of private trust companies to help them get around that. So you get a lot more sort of family office sort of type of feel. The important thing is good corporate governance. So if it's a New Zealand company, which is what PTCs are in this particular context, they need to have a New Zealand resident director. So we don't have corporate directors in New Zealand. So you will need to have at least one of us on the board to try and help, and that'll help from a compliance perspective, due diligence, the governance aspects of it, keeping you up to speed of what you need to do in the filings of that company from a company law perspective. And from a trustee perspective, it also we work closely with boards of individuals on the boards to help them make sure they are doing things properly. They're thinking of it from the perspective of what a trust actually is, acting in the best interest of the beneficiary, looking at making decisions properly, especially when it comes to things in relation to operating businesses where we see these used a little bit, but not necessarily. It can just be a case of a high net worth individual wanting their own trustee and having greater control at that level. And so, as you see here, I haven't put in, typically tend not to see things like protectors and other things happening here, because the trustee is basically either not the client or the client's representatives, if it's not a third-party professional trustee. So then they have a lot more control at that level. You can still have investment advisors at underlying entity level, and there's nothing wrong with that. You can put protectors in. You can certainly have all those different levels of control as well, because if you're not going to be on the board, say as a settlor, then you might still want to have those layers in place, which is totally fine. But quite a lot of the times, because the way they're structured, they try and be fairly independent. So they'll be appointing people like maybe it's the lawyers or trusted individual, or it could be someone in the business and the operating side who's a close family friend, who's a professional as well. They really are quite flexible sort of vehicles. So in terms of, just this last, I mentioned share options very briefly, but because of the foreign trust regime, if you have a foreign company overseas that's acts as settlor and its employees of the business, there's no reason why you can't have share options running out of the New Zealand foreign trust. I think I mentioned earlier, your settlors, beneficiaries can be corporates. They don't always have to be natural persons, which is different to some laws around the world. But you can certainly, so you end up with a nice, you can certainly mix and match a lot of these things up. So those sort of talking quite a bit about the New Zealand side. We've got some time at the end for questions, but I think this is probably the end of my short little dash through the New Zealand side of it. I think there's another, I've got the slides for Sebastian. So if Sebastian's there, I can just control your slides if you like, or unless you have them separately on your machine. And I'm happy to control it from here, or you can control it.
Yeah, I'm happy for you to continue controlling. No problem at all. But I think there are two questions. Maybe we can address that now. So there are questions about the, well, there are even more questions. If we look at the chat, can the settlor be Australian or French or any citizen? And how the underlying entities move money to the trust, dividend, interest, royalty fees. So maybe we can address these two first.
Yeah, the Australian one's a good one. It used to be a case of, because the close proximity to Australia, a foreign trust is still a foreign trust with Australian resident, with Australian settlor in it. But there are particular close ties with Australia. So if you could certainly have your trust here if it was an Australian, but you'd be wanting to get pretty good advice in Australia for that because of the nature of how the ATO are and their rules around trusts. It used to be in the old days, we'd have a form that you'd fill out, and the first thing they wanted to know is there an Australian settlor? It was the first question on the form when you're filling these things out. So the answer is yes, you probably can. It's just a matter of what the tax situation is going to be for them in their home country. The other question, I think there was a French one in there. I think it was a French question on French settlor. Yeah, look, I mean, France seems to be changing a lot of their rules, and before that they didn't recognize trusts at all. There seems to be some maybe softening of that. But their tax regime is, if you're a tax resident in France, there is a particular form from memory that you have to complete. There's quite a bit of regulation that you have to do to disclose it all. And because they're taxing you at, I don't know, 99% or whatever it is, crazy thing over there, it's something that's you've got to be very, very careful of. So it's not a case of I'll set my trust up as far as I possibly can away from France and I'll be fine. Well, no, because you've got a whole lot of regulation you need to do, and with CRS as well these days, all that stuff's going to be reported more likely because of the way this is going to be treated as an FI. So you can, again, it's subject to advice in France, but it might not be the most efficient. If they're I think even if you're non-resident, you'd have to be a little bit careful about how the rules affect you. So there's certain individuals. It's like I guess it's like being a US person setting up a trust. You still got a whole lot of responsibilities, no matter where you are. So, sorry, what was the other question? There was a couple.
The next question was from Dickie. How do the underlying entities move money into the trust? Is it through dividend, interest, royalties?
Yeah, so if you've got the asset, if you've got an underlying company set as contributed to your trust at the beginning, and then how does it flow? There's different ways of doing it. Some of the companies will have a bit more flexibility in terms of how they can return capital to its owner. It could be through reserves, it could be buybacks, it could be just Then if it's income, it could be dividends. You could hold preference shares. You could redeem preference shares. There's a whole lot of different ways of doing it. It just depends on the nature of what that underlying vehicle happens to be at the time. So that's how you would possibly do it. It just depends on the nature of your vehicle. Or you could have loan funding. So you might have funded that company by, maybe there's a loan arrangement in place, financial arrangement in place that you have done, and work, it's efficient, and then in the future it's generating profits and it's repaying a debt back. The trust may or may not. If you're going to do it that way, then the trust would probably, quite often we have a lot of trust with no bank accounts, right? Because quite often the funds are held at the underlying structure level and they're accumulating and they're generating it. So to have another bank account is perfectly fine. You can do it to receive funds and pay funds, or you can do it at the underlying company level. From efficiency point of view, just that I know some regimes prefer that you flow that all the way to the trust, and the trust pays that out, especially if it's distribution. If you don't do that, it can be treated a different way. It can be very harmful from a tax perspective.
Okay, and the last question was, can the settlor, and I think you answered it, but can the settlor be any citizen?
Yeah, more or less, just subject to their local advice, really. That's what I always say. We would always be careful when we're looking at trusts and settlors, where they're coming from. We often say, are you taking proper legal or tax advice? And before you start doing this. And there's other reasons, obviously, but obviously it's still a part of if you're doing it for purely estate planning, that's great, but you still need to think about, is it going to really cause me an issue from a tax perspective?
Okay, we're good to go, Sebastian.
Yeah, thank you. So as everyone knows, Singapore, or the trust business in Singapore, the trust is around in Singapore for a long, long time now. And since 2005, the trustee activity is regulated by the MAS and subject to licensing, a very strict licensing regime. So Singapore has gained a lot of credibility over the years in having very, very strong regulator, or being in a very, very strong regulated environment. So the trustee activity are mainly subject to two main regulation, which is the Trustee Companies Act and the Trustee Company Regulation. So this is really the framework under which we have to operate as trustees. So and as everyone knows, the MAS is not joking around with the regulation and with the activity. So on the one hand, some clients may complain about the regulation and how we have to do our business. But on the other hand, it really gives the credibility as well in their own country when there is any reporting done about why they would use Singapore as the jurisdiction for holding their offshore assets. In terms of the trust law, or the features of Singapore trust law, I think the main one that everyone knows and which is very popular and very appropriate in Asia, considering how Asian client wants to retain control. So David talked about the PTC previously. That's of course one option, but one of the most popular feature and item on Singapore is really the reserve power of investment for the settlor, which means that despite the trustee being the owner of the assets and having the authority and any discretion to manage and administer trust funds, of course, always for the benefit of the beneficiaries, the settlor can retain the power to make investment decisions, whether it's on bankable assets, whether it's on operating companies, and it applies to the assets that are in the trust already or have been contributed to the trust, but it also applies to any new investments that the settlor will want to make. So at one point in time, the settlor may identify an opportunity. He simply will write to the trustee that he wants to invest in XYZ company and for that amount. So he will instruct the trustee rather than request the trustee to consider. The trustee are really are almost under the obligation to do it. There are, of course, certain exceptions where the trustee can say no, but they are very, very few and very, very limited from that point of view. So the settlor can retain the investment power. So of course, he can also instruct the trustee to delegate this investment power to whoever he chooses. It can be an investment manager, it can be a trusted advisor, it can be whoever. There is, again, no authority or no discretion for the trustee to say no. So they are basically, I know that there are a lot of talk about this investment reserve power here in Asia and here in Singapore. A couple of advisors say yes, but the trustees still remain responsible and liable for the investment performance. So they have to at least monitor, or look, oversee what's going on and how it is going, and etc. etc. But there have been 2 recent cases where actually investment went very bad. Performance was really, really bad, and the court say that because of this reserve power, the trustee are not and will not be held liable for the performance. So so really that's a very strong it's very, very strong in the legislation. There is nothing for the trustee to do. So basically, also the good things about it is when a lot of countries now, a lot of jurisdictions are looking at the control and management and looking at what the settlor or what's basically the clients of the fiduciary services industry are doing and how can they retain their control, because most in the past they were saying, well, I give everything to the trustee, I have no control, I don't know what's going on, they are the legal owner, they do whatever with the funds, but actually they were continuously in contact with the trustee and almost giving instructions. So at least with the investment reserve power, they are comfortable with that, and basically they can claim that they have no control except to make investment decisions. And that come back to possibly the jurisdiction of where the settlor is, or the question about whether the settlor can be any citizen. Yes, it can, as long as, of course, it's not breaching the mainly the forced heirship rules in its country. But Singapore has forced heirships law, or anti-forced heirship provision, which basically any foreign forced heirships law are not enforceable in Singapore trusts, if, again, provided that the settlor had the capacity to transfer the property. So again, any citizen can do that, but must be careful about not breaching any regulation in his country of residence. If that's the case, then there is nothing the heirs can do in Singapore because of this anti-forced heirship provision. The perpetuity period in Singapore is of a maximum of 100 years, which from time to time creates some issues, not necessarily when you set up a new trust, but more when maybe you had a very old trust set up by your grandfather or grandfather, and basically you want to set up a new trust and decant, what is called decanting the assets, so moving the assets, distributing the assets from the old trust to the new trust. So that really could create some issue in terms of the perpetuity period. From a tax point of view, and of course without giving tax advice, the regime in Singapore is what is called the qualifying foreign trusts, where that basically means that the trustees, the settlor or the beneficiary, are not Singapore residents, Singapore citizens. So basically, if that's the case, the trust and the income is exempt from the Singapore tax system. And an interesting point is that the tax exemption as well applies to the underlying companies. So it's not only the trust which is tax exempt, but also any income generated at the underlying company level, of course, provided that the underlying company is not incorporated in Singapore. So that's basically what the main feature of the Singapore Foreign Trust are. It's not very different from New Zealand, from any other jurisdiction in terms of how the trusts operate, in terms of who are the parties. There is no specific things to mention from that point of view. I think, again, we do have a couple of questions maybe that we can address before moving to the next slides. It's basically what is one of the questions, the minimum size of wealth that requires trust setup. I think that it's not necessarily the size, and David, happy for you to comment as well. From my point of view, it's not necessarily the size; it's more the type of assets that are going or will be contributed to the trust. Of course, if you're talking about 100,000, I don't think a trust is appropriate, but more from a fee or ratio point of view. But it's more the type of assets and where the assets are. If you look at, if you are in Singapore, for example, you can easily cover your assets with a will. If they are not of a significant amount, or if you have no concern about the capacity and capability of your heirs to manage the assets. If they are sizable, of course, there is a lot of merit to consider setting up trust, even if you are in Singapore. But the trust is really appropriate, again, to from a pure international succession planning point of view. So if you have assets in London, in Switzerland, in investments anywhere else, the trust vehicle, no matter the amount of the assets, is again appropriate here, because you prevent the grant of probate in each of these jurisdictions. So sometimes the clients say, well, but my assets are not sizable enough to have a trust at this moment, and I will have to pay a certain amount as annual fee. But actually, when you compare the amount that you pay as annual fee during the life of your trust versus the amount and the inconvenience caused, the amount that you have to pay and the inconvenience caused by the grant of probate in each of these jurisdictions, and you really realize that even trust, even if you have to pay the annual fee for trusts, that's a lot of that's very appropriate. In terms of the yearly fee to maintain a trust structure, I would say it's really depending on what especially as an independent, we are always looking at what is the responsibility of the trustee to all the assets. So the fees will vary and depend on the type of assets and, of course, the amount of the assets. If we talk about basically bankable assets with a discretionary mandate, the responsibility is relatively limited from that point of view, especially if we have the investment reserve power in place. So probably you can look at something like an annual fee of 6,000 to 7,000 in Singapore. Then if we start talking about, again, a property in the UK and operating companies, an investment in private equity, etc., then the fees will increase commensurately with the responsibility. In terms of the Singapore residents, okay, so For the Singapore residents, of course, cannot indeed set up foreign trusts. The trust will not be foreign. The trust will be what is called a LAT, a locally administered trust. Basically, it still makes sense to set up the onshore trust for Singapore residents if the assets are in Singapore. If the assets are maybe somewhere else, well, you still could have a Singapore trust, because as long as the income is overseas, is not taxable. It's just a question of when you will bring back this income to Singapore, what's going to happen and how it will be taxed. But I would say that, yeah, having a trust in Singapore for a Singapore resident could still make sense, and there are a lot of course, advantage of Singapore residents to have their trustee here in their jurisdiction.
Perfect. So it appears as if those are all the questions for now. Do we move on to Hong Kong?
I just wanted to quickly cover the scenario where David, if you can move to the next slide, it would be great. So it was just something that came up a couple of that came out recently, and especially because of the pandemic. A lot of people have suddenly realized that when they have their assets, when they own all their assets directly, because of the pandemic, they might be at one point incapacitated or incapable of managing their assets. Then that creates serious issue. A typical example: if you stop in the hospital, then basically you are the sole owner and sole authorized signatories on your bank accounts, or sole director of your operating companies. Basically, nothing could happen, and everything is basically stuck. So we've seen a lot of interest over the past few months, where people suddenly realize that they cannot be the one and only in control of the assets, and that's where basically the trust is again extremely appropriate. So if we can move to the next slide, David, please. Then you can see that's the slide that David commented before. Basically, with the trust, you still have a legal entity, or someone, a company, the trustee, which is a legal entity acting as trustee of the trust. Trust is not a legal entity, but basically they can continue to control the assets. They can continue to have access to the assets, have access to the bank accounts, make distribution to the beneficiary if they need some money, if they need funds to cover their expenses for their maintenance, etc., etc. You can still continue to deal with the trustee can continue to deal with the real estate agents or the property. You can continue to manage the operating companies. It's simply basically as shareholder, you can appoint a representative on the board of the operating companies to replace whoever needs to be replaced at one point, and to basically continue operating and have the operation running. So again, that's an illustration on, yeah, trust is not only to address or to basically cover the case where the settlor or the client passes away or is basically incapacitated. That's also when there are situations like we are now in, where the settlor just cannot deal with the management of their of the assets.
Okay, thank you very much for that. And would you be continuing with Hong Kong as well? or Joe, is it going to be you?
Could I ask one question on Singapore?
Sure, please.
Yeah. In the discussion on Singapore, it was mentioned that there's no Singapore tax if the settlor and the trustee are non-Singapore resident. What happens if the trustee is Singapore resident? I mean, it would seem that the trustee would have to be Singapore resident for it to be a Singapore trust, because the trust is resident where the trustee is resident.
Is the trust is the settlor and the beneficiaries?
Oh, sorry, the settlor and the beneficiary. Sorry, I didn't pick that up. Okay, that's fine. Yeah.
The trustee must indeed be a licensed trustee in Singapore.
Right. Just one other question, and that is, I have some clients who are running operations through Singapore companies. We're working with Moores Rowland to try and open bank accounts, and unless you have large sums of money and you have a business that is actually operating in Singapore, it is very, very hard to open a bank account. Now, if you're promoting Singapore trusts, how do you get on with opening a bank account for the Singapore Trust in Hong Kong? I mean, we're using DBS in Hong Kong. We've tried DBS and got nowhere. We've tried UOB, we've tried OCB. It is just a total frustration in trying to open a bank account in Singapore. Can you enlighten us? You may have some special intro with, I don't know, Standard Chartered or HSBC or somebody.
Yeah, I certainly share your frustration, because that's what we've seen for the past few months. It's getting more and more difficult to open bank accounts in Singapore. I think what happened with the Panama Papers, Paradise Paper, whatever, as basically the banks are really reluctant now to look at this fiduciary services business and to basically open account for companies or for trusts. It very much depends what the assets will be, because as with any banks, they would be interested to see money. So if you have a trust and an underlying company with bankable assets, and these assets, I would say, are now between 3 to 5 million, then the banks will certainly open the door and be happy to consider. If you come with an operating companies, operating companies should be okay, because again, there must be a resident director here in Singapore. If you can demonstrate some operation and some trading and what the company is doing and all that should be okay. The problem is really a Singapore investment holding company. That really starts to be difficult now. They want to understand the purpose of the company. They want to understand the purpose of the structure, and unfortunately, some are not open or really understanding why someone in Thailand, for example, will open a Singapore investment holding company. They don't get why this person would not want to have a personal bank account in Hong Kong. So you can, of course, try to justify that, well, wants to have this money outside of the country for the reason that everyone knows, and basically securing strong currency in a very stable environment and all that. But again, you need to come up with a substantial amount for them to consider, because that will fall under the private banking segments of the bank.
Sorry, and on that topic, David's question, I was just wondering, I know we probably don't want to compare like Singapore to New Zealand, but perhaps isn't that one of the I don't want to say benefits, but one of the attractive aspects of a New Zealand trust, in that the bank tends to be less complex? Is that a fair statement?
Yes, it is. It's easier in New Zealand. Well, not difficult in New Zealand for the foreign trust to have a bank account, providing you're open. In other words, they go through all the KYC stuff and check everybody out as usual. But the banks here welcome that sort of business.
Mm. The
David,
banking
is that your experience, David, as well?
Well, the banking system in New Zealand is certainly not terribly sophisticated in the sense of if you have foreign individuals who aren't resident here, it is quite problematic to try and opening up a bank account in New Zealand. Whereas if we try and open up a bank account for a trust somewhere else, for some reason it's a lot easier. I never really understood why that is, but it tends to be that's the way I have. So if I go down the road and I've got a client, I go, look, got this, and they look at you sideways and they ask you why and how, and it's a very unusual experience. So whereas you go to an overseas private bank or institute, they'll go, you give them all the due diligence, and as long as it stacks up and there's no nasty compliance hits on anybody, it's a lot easier. But everybody obviously nowadays, they want to verify source of wealth, source of funds. If you don't do that in any shape or form, you haven't got a chance of doing anything. And it's the same goes with professional licensed providers now as well. We're all subject to the OECD sort of more or less the OECD rules on AML. And New Zealand's no different to say Singapore would be on that front. It's just for some reason, I don't know why, but we have a lot more success opening up bank accounts in other places than we do here.
Okay. I know that we're a bit behind on time, but Hong Kong? Which one of you doing Hong Kong?
Not me. We did talk about Hong Kong, but we don't. I personally, I see stuff around the group, but in both Sebastian and I have had some experience with Hong Kong, but we actually don't do our trust services out of Hong Kong. We use our Hong Kong as a fund base, as a ad fund, so we don't sort of push that out. I think the laws are. I lived there for a little while, it feels like a long time ago. And the trust laws are not too dissimilar. You have reserve powers and things like that. But in terms of the expertise that we have there, is where I certainly wouldn't be comfortable telling you anything about that from a tax point of view anyway.
Okay, understood.
I was doing Hong Kong trust in the 80s and 90s when I was with Coopers and Lybrand, and we had thousands of trusts, but with things changing in the PRC, in the early 90s, we were putting flea clauses into all of our trusts. Such that if the PLA came across the border, the trust would automatically move to the Isle of Man or something like that.
And I was with Deloitte up there in Hong Kong, and we were certainly there was I think every single trustee had those things in them, and hopefully no one would ever have to use them. But at the moment it always seems a little bit uncertain with what's going on. Although being in New Zealand, I haven't heard anything recently from my colleagues up there, but certainly for a while there was a lot of I'm sure it's still not great. A little bit with the uncertainty that's happening. But I mean, we certainly are focused up there in our fund world rather than our trust world. If clients are looking at trust structures, we tend to sort of look at either Singapore or New Zealand, funny enough. And if they're looking at offshore, they look at sort of Cayman or BVI for the structures there, because quite often they'll probably have a Cayman or a BVI company already in place. There's nothing to say you couldn't have a trust in New Zealand or Singapore with that, but sometimes depending on how sophisticated they want to be, they might want to have a BVI Vista Trust, which is obviously quite special, and it works quite well for them in terms of what that BVI company is doing, as opposed to say a more traditional structure which you might see in Singapore or say New Zealand.
Yeah, I appreciate probably sensitivities around Hong Kong right now, but if we step back and look at the three jurisdictions, I know one jurisdiction isn't better than the other, but can you, from your experience, of course, identify who will be the ideal type of client for New Zealand versus the ideal for Singapore and perhaps Hong Kong? please?
Yeah, I think from my perspective, we've talked about this not so long ago. Actually, we were all sort of wondering about that, and I think with New Zealand being almost your family office type, I hate to say it, but you're probably your family office type of client. The reason for that is someone mentioned earlier a little bit about the fee levels, and Sebastian hit the nail on the head with what type of assets. I mean, if someone asks me, I always say, well, your assets important, but also you've got to weigh up the economies of scale in terms of fees and things like that. So if you've got less than 5 million and it's not making much of a return, you're going to find your trust costs, financial statement costs, your reporting costs, no matter which jurisdiction you're in, are going to be throwing that away. So you need to bear that in mind. So, but then again, in the bigger picture, if you hold them directly and you go through a probate process, or you have a dispute, or you might have a whole world of hurt, that's better if it's sitting in the trust. So, I mean, I think from New Zealand, we have mixed of clients from all over the world. Certainly, yes, high net worth clients. There's nothing small in our client base, we're quite open and honest about that when we're talking about setting up structures. They're generally long-term structures. These are the costs. These are the advantages, as opposed to say, let's put $500,000 in a trust for a rainy day. Well, yeah, that's probably not going to be the best type of client, only because it's going to cost you too much. You'd be better off maybe you have an insurance policy or something like that. Then again, you might have a BVI company that's set up already, and you can play around with the shareholding of that company quite nicely and the laws over there. But because we're focusing here on trusts, I'd say from my perspective, it's certainly more the high net worth clients. Sort of 5 million, anything below 5 million is going to be, I think you'd find might not be economical. We're quite flexible with those sorts of arrangements. So if it depends on what they want to do, if they're going to do transactions all the time and they want regular distributions, and it's going to become costly. So I certainly think you're probably a more sophisticated maybe client, and then you can choose whether or not you have a PTC type of arrangement or you have a professional trustee. From my side, from the New Zealand side anyway.
Right. Someone has asked below, when you say 5 million, do you mean 5 million US?
Yeah.
Yeah.
Okay.
Yeah.
I would agree with, I've got several of clients of David's ilk, and I would agree with him, and I have actually said it to people, unless you're in that bracket 5 million plus, and earning revenues of, if they're underlying operating assets, earning revenues of in excess of $1 million US, you've got to look at, is it worth their while?
Yeah,
could I just mention one thing to you guys? You may be aware of this, but the Caymans, at the end of 2019, the Caymans was mentioned. They signed up, under the OECD to information sharing. And so this is something we all have to be aware of. And the reason why I raise it is because I personally, that is me personally, I had a letter from the New Zealand Inland Revenue Department a month ago, because I act for some Cayman companies, for clients. They actually they set out that the New Zealand IRD is now part of the information sharing arrangements with the Cayman Islands, and that the that the Cayman Island authorities had advised the New Zealand Inland Revenue Department that I was associated with certain bank accounts, and they gave the name of the client and the bank account number. And had I reported that in my personal tax return, that is my fees that I've charged the client. The answer to all of that was yes, and I agreed with them on the name of the client and the bank account numbers, and set it all out. Anyway, I got a letter only yesterday from the IRD saying, thank you, end of the matter, everything you say is okay. But the level of information sharing that's now going on out of the Caribbean, that we have never experienced, is clearly now happening. As I say, personal experience of that, just only
It's a real thing. I mean, I think that they're fighting with the UBO, the so-called UBO registers, and you see a lot of jurisdictions now sort of introducing those sorts of things.
Yeah.
Which is it gives some people a problem. It's just the privacy aspect. It's not like they've got nothing to hide from the tax authorities. They just don't want bad people to know what they're doing and then them disappear or the families disappear and get ransomed or something. So those sorts of things are a real concern. The information sharing has been significant, especially with the introduction of you've got your CRS now for a while. You've got the spontaneous exchanges that you can sometimes hear about. As well as not that long ago, you'd have your information requests would come through the tax authorities to the professional, and the professional would take advice and then maybe argue it for a while to try and justify whether or not the foreign tax authority has actually legitimate reasons for requesting the information in the first place. So yeah, a lot of that information seems to be moving around without that anymore.
Okay, I guess we've come to the end of our session. Thank you very much, Amiko, for sharing your time and, of course, your expertise. If any member of the team, if anyone wants to reach you guys, what's the best way to reach you?
Email's pretty easy from my perspective. I think we're all fairly reachable on email. Darren, you've got our email addresses, and feel free to circulate them. And then we can reply back, and we can speak to them on WhatsApp or Skype or whatever works.
Mm-hmm.
You want to share the slides, David, and then put our email addresses there?
Yeah, well, I can certainly send us. Yeah, I can certainly do that.
And Darren can distribute.
Do you have it on one of your slides right now, so you can just flash it?
Yep. Oh, yeah, but it hasn't got my email address on it. I think about it. I don't think it does. Let me have a look. I'll just go to the beginning. Hang on a sec. I'll just.
Sure.
Yeah, I think it's.
Because we're going to make this recording available, so if anyone sees it after the fact, they can, hey, I want to email David or whatever.
Yeah, sorry, it doesn't. It doesn't have it on there actually. Okay,
so anyone watching, you can just reach out to me directly, and I'll introduce you accordingly. That's no problem.
Sure. Great.
Okay. Thanks a lot, gentlemen. Have a great day ahead.
Yeah, thanks very much.
Thank you.
Bye-bye.
Bye, everyone.